Hello everyone, welcome back to Stock Spy. About a month ago, I shared a video on the trade desk where I recommended the stock as a potential buy the dip opportunity. At the time, I highlighted its strong position in ad tech, especially in connected TV and programmatic advertising. Fast forward to today, they are sitting at a 5-year low. In this video, I'll cover what happened in the past month, why the stock sold off so heavily, and what investors should look forward with some clear recommendations in the end. Back then, my view was simple. TTD had a strong long-term outlook thanks to its open web focus. I believed investors were overreacting to short-term risks like macro headwinds and competitions. I saw the dip as a possible entry point for a long-term investor. That was my call, so let's examine what changed in just a month. The main thing that happened is that the stock crashed. In August alone, they fell more than 37%, making it one of the steepest monthly drops ever. Year to date, it's now down over 50%. Q2 revenues grew 19% year over year. Still solid, but it is way slower than the 26% we saw previously. The management guidance for Q3 revenue grew only 14%, which spooked the investor who expected acceleration. To make the matters worse, Netflix struck a deal with Amazon DSP to sell ad inventory, raising questions about TTD's positioning in connected TV. This deal suggested Amazon could tighten its grip on streaming ad sales, a space where TTD had been seen as a leader. CEO Jeff Green warned that large brands are pulling back spending due to tariff concerns and trade policy uncertainties. That raised fears of a broader slowdown in ad budgets. Then there was the leadership change. TTD appointed a new CFO, Alex Cal, in August. While fresh leadership can be good in long term, it always introduces a near-term uncertainty. Not to mention there was this valuation concerns. They have historically traded at a premium price to sale multiple above 20x. After the crash, it's closer to 10x, but still higher than many peers. Investors now want the proof that growth and margins can justify even this lower multiple. At a 5-year low, the stock clearly reflects fear, slowing growth, competition, macro risk, and valuation doubts. But there is always a silver lining. The expectations are very low. If TTD delivers even modest surprises to upside, sentiment could turn real quick. So here are the key drivers. The revenue trends. Can growth re-accelerate back to 20 to 25% range? Or at least beat the low guidance that they have provided? The margins, the strong gross margins are there, but investors want to see improvement in operating leverage. How they respond to Amazon Netflix deal is also critical. Winning new partnership would help defend its position. If the tariff pressure eases or advertising budget bounce back, TTD could see a faster recovery. Valuation part, if the growth stabilizes, current multiples could actually look attractive. If not, there might still be room to fall. Here is my take. As a long-term investor, this is shaping up as an opportunity to gradually build a position. If the stock holds in the $40 range and shows stabilization, the risk reward improves meaningfully. The dollar cost averaging might be the smarter play rather than going all in. For a short-term trader, patience is a key. Wait for confirmation from Q3 results. A bit on revenue or improved guidance could spark a rebound. Another miss, on the other hand, could drag it even lower. Avoid chasing. Don't buy just because the stock looks cheap. Make sure the fundamentals back it up. If competition from Amazon worsens or advertising budgets shrink further, downside risk remains. 1 month ago, I was bullish. But new headwinds like Amazon deal with Netflix, weaker guidance, and macro headwind worries have added the pressure. Still, their long-term thesis hasn't disappeared. The digital ad market is growing still. CTV is expanding, and the TradeRest remains one of the few independent platforms outside the big tech walled greens. So, for a long-term believer, the current weakness may prove to be an attractive entry point. Just be prepared for volatility and consider scaling in slowly. For others, wait until next quarter results. This could be the safest move. Thanks a lot for watching. If you found this video helpful, make sure to like, subscribe, and share your thoughts in the comments.